So last year, or in the last few years, when you had your tax return done, you learned that you had a huge surprise tax bill and you were completely caught off guard by it. That should never happen. If that is you, this video is going to help you prevent surprise tax bills. I've owned my own wealth management and tax planning firm for over 13 years. I've been a financial advisor for over 25 years. Along the way, I have met so many people who share their stories with me about a large, unexpected tax bill that completely catches them off guard. The situation is usually something like this. Wow, we had our tax return done and our accountant told us that we owe over $100,000 that we weren't planning on. This creates a lot of stress and a lot of anxiety, and it can be completely avoided if you follow the 3 steps that I'm going to share with you. Generally, you get hit with a large, unexpected tax bill because your income throughout the year was greater than the year before, and you did not withhold enough in taxes, or you did not make an estimated payment, or your estimated tax payments were not large enough. So the first step to eliminate large, unexpected tax bills is about August. You need to identify all of your sources of income for the year and track what has changed. You want to use the prior year's income as your baseline and then look for deviations. How is your business doing if you own one? Is your business going to be more profitable this year versus last year? Do you have rental income? What's going on with the rental income? What's happening with your dividends from your investments? What about interest income? What about royalty income? All of the different sources of income. Have you sold any investments? Will you have capital gains from selling investments or real estate, private equity, things like that? All of the different sources of income need to be analyzed and then look for the change. What has increased throughout the year? I think it's best to simplify this as much as possible. Think big picture. For example, if you own a business and last year you made $500,000 and this year it looks like you're going to make $800,000. That's a $300,000 increase in profitability. You're probably going to owe an additional $100,000 in taxes. You're going to need to adjust your estimated payments. Otherwise, when you have your tax return done, you are going to get a surprise 6-figure tax bill and you will get hit with penalties for underpayment. If you're the person who has investments all over the place, consolidate them. If you have 10 different investment accounts, take them down to 1. It makes no sense at all to have investment accounts all over the place. You're only complicating your tax life. You're increasing the odds that you're going to make a mistake. It's so much easier from a tax, compliance, and reporting perspective when you have 1 after-tax investment account versus 10 or 15. And yet, lots of people do this. If you have a bunch of fancy investments that generate K1s, this would be a good time to analyze whether or not you want to keep making those investments. In my experience, most investors who start investing in private deals will go through what I call the private investment life cycle. They'll start by getting into private investments and increase more and more and more. Pretty soon they got 20 or 30 deals. Then they end up tearing their hair out when tax time comes. You have an extremely expensive tax return because of all the labor that needs to go into that return, and your tax life is a total nightmare. Planning is very, very difficult. And then when the person reaches that point, they stop making those private investments. Look, Warren Buffett is, he's been vocal on this for many years that very few private investments can even keep pace with the S&P 500. That's due to the high fees for the GP. Generally, the only person beating the market in a private investment is the GP. So it's a good time to reevaluate, do you want to keep this tax complexity by having a bunch of K1 producing investments? Once you have an idea of how all your sources of income are changing throughout the year, step number 2 is to report the income increases to your tax advisor. Then he or she will be able to help you with a tax projection and estimated tax payments and any increase in withholding that you might need to make. If you do your taxes on your own, You're simply going to look for the change, the increase in income, and then estimate as best you can how much additional tax you're going to need to pay, and then get squared up with your estimated tax payments. Step number 3 is to over-withhold taxes on your W-2 income and any 1099-R retirement distributions. This is an important step because withholding taxes through payroll and with your 1099-R retirement distributions is going to help reduce penalties from being short on estimated tax payments. If you follow the 3 steps that I just outlined, your tax surprises should be greatly reduced, if not eliminated entirely. There is just no reason to have large surprise tax bills. I own a business like many of you, and what I do personally is every 3 months, I analyze my revenue and expenses and track the profitability for my company and make any estimated tax payment adjustments that I need to make. By the time I get to the end of the year, I already know what my tax bill is. There aren't any surprises. Follow this simple 3-step plan and you will eliminate the tax surprise. If you have questions about your investments and taxes, please give my office a call. We would be happy to give you a free second opinion. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments and overall improve your family's financial plan.